a Q&A. It's going to be a Q&A session for you guys. Just want everybody just to type into the chat, just so that I know that you can see the screen. I'm sorry about the date on the PowerPoint. I had some problems trying to receive the PowerPoint, which I did. Okay, a few people are saying they can hear me. Francois, it's nice to see you in here again. Let's do it like this. The webinar is going to be Q&A. I haven't really prepared anything for it, but I think what I believe you guys need the most is just to learn how to protect your open trades. What I'm going to try to do is in MT4, I'll try to, with the drawing tools on the webinar, draw on the hedging strategy which I use. Francois, seeing as you're the only one that let me know that you're here, quite a lot of people are here now. I need to know that everybody's here, everybody's listening, everybody can hear me and see the screen. What I wouldn't want to happen is for you guys to be sat there with a blank screen and no sound. So I'm going to give it 1 minute before I get into things, and I want to see everybody typing in their question bar or the chat bar. They can hear me. 1 minute. Okay, everybody, let's get going. Nice to see you in here, Selena and Francois, and all you other guys. Let's do it like this. Where would you like me to begin? Would you like me to go over Heiken Ashi again? How has it been going? If you just type into the question bar, Francois, Selena, or any other guys, how is it going with the trading? I know it's been a little bit rough with the FOMC, and you know, we all lost money, made money on this. Where would you like me to start? Briefly going over, I mean, this, like I said, this is an old PowerPoint. I have to do the second slide, which is, you know, this material is purely for educational use. Using this strategy, you know, it's part of money management, part of risk management. It's there to try to help to protect you, but it is in no means trading advice. That is the legal warning which I have to give you at the risk warning. I'm sure you know the risks of the market already anyway. Previous webinars, recap, showed you how to use support and resistance, showed you how to check on different time frames for charts. Whereabouts are we in terms of your strategies? Are you making money, losing money? Do you feel like you're getting somewhere? Just let me know. Francois, for instance, how is it going for you? Fantastic. 10% up last month. Need help on hedging. So 10% up could be 20% if you learn how to hedge properly, I believe anyway. Hedging, it's like any other strategy. You need to follow the rules quite strictly. If you don't follow the rules strictly, then you can get yourself into a bit of a mess, and you know, you can have a lot of trades open and have no margin because you're fully hedged. Nobody wants to be sat there with 50 lots long and 50 lots short. It doesn't matter which way the market goes. Eventually, you're going to lose because you're going to be paying swaps unless you have an Islamic account. We looked at how to identify tradable ranges. What I showed you basically was the Heiken Ashi method. You know, it's average candle. I'm going to quickly flip through these slides. We know all of this already. We know determining the trend can be really difficult. Learning how to hedge is a primary way of protecting ourselves. So determining the primary direction is the trend. it's working on a high time frame chart, moving the time frames lower so that you know where to place your trades. Opening the trade on a fast time frame if you want to trade intraday, and opening your trades on a longer time frame if there's an in-depth trend in the market. For instance, a euro dollar, pound dollar, down, 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 a little bit of pullback, maybe 23 to 31% pullback in the market. I don't know if you guys trade stocks, but if you are watching the market, I'm sure you're all aware of what happened to Volkswagen. And any of you guys that trade on the DAX, I'm sure that if you are long, you are no longer in the market, because most people actually blew their accounts if they were trading long on the DAX. Trend determines the direction of our trades. Obviously, if we can make money by counter trend trading, which is opening trades against the market, as I mentioned, always starting with a weekly, a daily time frame, looking for this major trend. The Heiken Ashi helps us to identify when the market's turning. If we look at the Heiken Ashi chart on a 15-minute, we can see that on this particular time frame, it's a 4-hour chart. We can see the trend is definitely moving down. It may have found support where the green arrow is. If I just try to draw on here with a drawing tool for you, we can see here that this is the trend may be starting to reverse. Nobody truly knows where the market's going to go, but the hedging is definitely going to help you. I'm going to just talk about and draw on my MetaTrader. I'm going to take a snapshot of the euro dollar, and we're going to just open a theoretical hedge by drawing on the lines. It's not going to be opening and closing trades, but identifying when the market's turning. So, you know, do we place a trade on the first candle, or do we place a trade on the second candle? It totally depends on whether or not you fully believe if the move is going to follow through. Excuse me. If there's no follow through in the market, then the market is going to continue downwards. But we can see that the previous high here, was clearly broken by the candle. So we can safely place a trade as long as our stochastic is crossing, as I showed you, using a 21 period exponential moving average or a stochastic indicator on your charts is going to help you with your entries. Okay, just get rid of this drawings for you. 1 second. Delete, erase. There we go. Okay. This is a 1-hour chart. As I said, I wanted you guys to put on their 20 period, 21 period, same thing. It's exponential. It's adding up all the previous candles and giving us a slope line. As long as the market stays above the slope line, then the trend is in place, and we can quite happily place entries when the market is above, for instance, here in this area, placing a trade on the first green or the second green candle. We may want to wait for the third green candle for it to clear the moving average. This is an entry point. So Heiken Ashi in itself is not a trigger for our trades. It's more an indication that the market's turning or continuation of a trend. We can see that the market in this particular area of the chart moved down. It was below the moving average, so we know that we're in the move. As long as we place a trade on the first candle or the second candle, then our exit is either going to be on the first green candle or when the market comes back and touches the moving average. This is your exit. It's very, very simple. It's like I talked to you before. It's identifying the first red candle and crossover on your stochastic. The most strong crossover is when the stochastic is in the 80 and the 20 area. Sometimes it happens in the middle, but as long as you keep an eye on the price action, then you'll be fine with your entries. But use of a moving average is always very, very nice. As long as the market stays below or the market stays above, then we know that this move is continuing. If this market from here were to turn around and touch the moving average here, then we know that there's a possible test of the previous high, which is here. So, you know, there's many different strategies which we can use. As a trader, we're looking for the easiest, the most simplest, the one where we can make some pips every day, make some money. But also, you know, you need to learn how to protect yourself. Once you've pulled the trigger and you've got yourself into a trade, you need to know how to protect yourself. And I think that's where Francois is lacking a little bit. 10% is amazing, Francois, but I think, you know, if you can get to the 15s and the 20s, you'd be a happy guy. As you can see, a little bit more of a detailed chart here. Shows you a little bit more about the moving averages, different moving averages. This is not one of my charts. This is something that I found on the internet. Not going to lie to you, but it shows you everything that I use in my strategy. You know, it uses a cross, an identifiable cross down here in the bottom left. So we're using a stochastic, same thing. 9 and 18 EMA, depending on what your settings are on your stochastic, you're going to get a cross. This cross, if we had a stochastic down here, would probably be underneath the 20 or on the 20, and the stochastic will be coming up, indicating a buy. We're waiting for a move of a down move and then the first blue candle. Or we can enter on the cross of the moving average, which might be here on the stochastic, or we wait for a move where the market is above the moving averages. So there's two entry strategies. You either believe fully in the stochastic by itself, or you wait for the market to be above the moving averages. Now, we can see here that in this particular area of the chart, entry of a long position. This is where this particular trader is thinking about getting into a trade, because the bearish candlesticks here, they're touching both of the moving averages. So he's waiting for these two candles to actually touch both averages. It must, even if it's a spike, it must touch both moving averages. First blue candle, here's the entry. Market moves up, as we said, it's above the moving averages or touching the moving average. This is a slightly faster, a 9 exponential moving average. Market is above. Now we have a choice. We can either exit on the first red, which would give us some nice pips from here to here. Would give us a nice amount of pips, or we wait for a true break of both moving averages again and the cross of the two moving averages. So there's two things happening in this area. The price action is coming through both the moving averages again at this point, and also we have the Heiken Ashi changing color again. So this could either be 0.1 to get out, or you could wait in because the market is still above the 9 and it's still above the 18, and we wait for this point, which is 0.2. Sorry for my drawing. Or we wait for 0.3. Market's still above the 18. This would be 0.3. I would possibly be thinking of getting out around the 0.3 area. And probably be waiting for the market to come back a little bit, because there's a chance that it's just going sideways here, that it's going to go into a range, and maybe that range is going to break upwards. In this instance, on this chart, the range actually broke down. So what we would do to lock in profits is we would use something called a manual trailing stop. Never use automated trailing stop. Automated trailing stop does not have a brain like you guys do. So what we're waiting for is three candle manual trailing stop. So every time the market goes up, it must go upwards before we increase our stop loss. Clear 3 moves upwards. If it's going sideways like this, it's not going anywhere. We will be counting all of this area as one candle because the market's not gone anywhere. So eventually we will be tracking this move. Let me just delete what I've got on here already. It's getting a bit messy. Let me just show you with the spotlight. We would be moving 3 candles. So we would have entered here. This candle here is the first candle, second candle, third. Our stop loss, let me erase these. Our stop loss would be here, first stop loss. So we're locking in that profit. Again, 1, 2, and 3. Second stop loss is here. Now we're locking in this profit. 1, 2, 3. Third stop loss here. 1, 2, 3. Fourth stop loss. Market comes back and takes you out automatically. That's the way of trailing stop. You know, what we could have even done is used a 5-bar stop loss. Would have allowed us to take the whole of this move into consideration. So we're waiting for 5 bars up. The market comes down. It goes up 1, 2, 3, 4, 5. Our stop loss is underneath that candle now. So we made from here to here. That's our profit. Or we use the Heiken Ashi strategy and the exponential moving average cross, which is on this chart. I wanted to show you this because I'm sure that you guys are keen to know when to get out of your trades. Most people, unfortunately, when they have an open trade, they wait too long. Market comes back, maybe there's some news. You're 100 pips up on the euro dollar. Mr. Draghi's speech about the interest rates, forward thinking, and before you know it, the market spikes 60 pips, 70 pips, and you lose all your profits. What you can do with this is if you bring your stop up, then as long as the price is available in the market, you know, stop loss and take profit are not 100% guaranteed from a retail broker. We only receive maybe 50 to 60% of the prices during the high volatility announcement. So for you guys that are wondering why your stop loss or your take profit don't work sometimes, it's because not every price is given in the market. So I'll move on to the, let's do a little bit of the hedge strategy because I know you guys are waiting, and I also know that you've seen this chart, but I wanted to recap for you. Scaling in, we did. Scaling in is basically, you know, I don't know what size volume you guys, Francois, Selena, you're trading with. If, for instance, if you're trading with the mini lot, then scaling in your trade would be, if you normally open up one mini lot trade, then you would open up maybe 50% of your original opening value and build the volume up to the mini lot. Or if you're used to trading with one lot, you would open up with a mini and you would eventually scale in one lot. If the market goes up 20 pips, you would open up another 10 or 20, 0.1 or 0.2. Then you would wait for the market to move again and scale in another 0.1 or 0.2. That is scaling in. It's a safe way of building volume and not, it's testing the water, dipping your toe into the market. Okay. Let's move on to the next. I'm going to take you to a live chart. Okay. 5 rules of the hedge. Opening a trade in the opposite direction to the original trade which you opened originally. Setting a recovery zone. I will draw onto a chart the recovery zone, the take profit zone. I use a 50 pip entry or zone, and I use 150 pip take profit. So I'm 3-to-1 on my trades, and I will show you exactly how that works. So you'll get a recording of the video, so if it looks like I'm rushing, don't worry. You can rewind it and watch it as many times as you like. Number 3, very important, understand the market will go wherever it wants to. It won't listen to you. If you want the market to go down and you're screaming at your screen, the market will go up if it wants to. Nobody has a crystal ball. Even Mr. Buffett lost around 16 billion, I believe, on one of the announcements, which is just pocket change for him. For us, if we lose $10,000-$20,000, it's it's a lot of money. It can be life savings or something. So it's nice to make small profits and be successful and protect your losses. Never take a loss unless the market is ranging and volume levels exceed your account size. And this hedging strategy is not the holy grail. Okay, this is basically my strategy, which I drew onto a chart for you guys. I'm going to take questions now. Any of you guys have questions? There's quite a few of you in here now. Type into your question box, chat box, and I will explain your questions first, and then I will explain the theory. Anybody have any questions? Okay, everybody must be happy and understanding everything. Must be a better teacher than I realized. Okay, we're going to go into this slide, which I think is very important. You can take a screenshot of your screen. This 50 pip zone, and I will draw on to the, I will spotlight actually. I will use a spotlight. I hope you can see that. Just wait, I'm going to see if you can see that on your screen. No, you can't. Okay, I'm going to show you the highlighter. Okay, let's draw on some arrows. Okay, my zone is here. I'll put the highlighter on. It's more clear. Okay, let's see if I can change the color on this. Don't like that. Let's go with red. Okay, that's better. My zone, 50 pips. Okay, 14.7 from Francois. Stochastic gives sometimes false signals. Is it related to volume? The market, yes. Sometimes, as I said, it won't get to the 80 and the 20, Francois. It will sometimes go between, and it will sometimes not do anything. What we need to do is we need to always watch the price. It doesn't really matter what the stochastic is saying. Once we've entered a trade, we're in that trade, and we need to control it. I think you would agree. What this strategy will do, it will help you protect. Obviously, these volume sizes, they're not for every account. For instance, if you only have $1,000, do not open up one lot. Do not open up 1.4 lot short. You need to do a tenth of it. So you need to go maybe with a mini, and then a mini 0.4. So 1.4, 0.14. Then open up 0.09. So we need to divide by 10. If our accounts are small, then you need to take into consideration the volume here. Figure out which volume suits your account. This size volume is for an account, I would say $10,000 and above. One lot, you should only be opening up 20% of what your account value is in margin. So if you have 20K in your account, you should never be holding more than $2,000 in margin in open trades. This is the amount of money it costs you to hold trades open, not including your P&L. Okay, so I'll give you an example. Let's say this is the euro dollar. This is the euro dollar chart. Let's say this is the candle. We haven't got to the point where we want to enter yet. So what we do is, as the market comes down, you feel like you want to place a trade and enter here. So this is our entry, and we are going long in the market. Okay, our take profit is 150 pips. Now, this take profit, it can be changed. You can use a different amount of take profit. 150 pips is a lot of pips, and normally takes, on a normal day, the euro dollar, maybe the euro dollar can do it in one day. The average amount of pips we see movement on a daily basis is around 120. Today, the pound and the euro, they move very nicely, but they dropped a lot, but pulled back around 30%. So all in all, the market did move around 120 down, but then we had about 40 to 50 to 60 pips back. So we play, let's just say theoretically we go long. If we hit 150 pips and we have one lot open, then we make $1,500, you know. But how many times do we ever get the trade right on the first attempt? Very, very low, I would say. So this is why I use it. I personally have never been past the fifth leg on this, and if it got towards the fifth leg, sixth leg, then I would consider, you know, closing out with loss. Unfortunately, you don't want to be holding 10 or 15 lots of an instrument. It's very risky. This is, you know, you should really be using a lower lot size. I normally use 1 and 1.4, 1 and 1.4, which is on one of my net screens, but this is just a different volume to show you that you can do it. So let's say we went long, but the market went to here, didn't reach our take profit and turned around. Okay, what we do is the market moves down, down, down. Once it hits our 50 pips, we open up a counter trade. This is a hedge. Now you'll notice that the lot size is different, so that if we had one lot long at 150, that would be 1,500. If we had 1.4 at 150, then we would have something like 1,600, something like that. I don't know the exact calculation, but we would be making more in profit than we will be in loss. So if this trade is losing, it would be losing 200. So it would be losing 2,000. Okay, this would be 2,100. So if the market came to here, this particular lot size would give us $2,100 profit. This trade, however, would be in $2,000 loss. Sorry for the drawing again. So the hedge, it actually allowed us to get out of that trade, even though it was a losing trade, this first one, with $100 in profit. Now, let's say that the trade goes against us again. It doesn't go all the way. It actually turns around, so it comes, we place our trade here. It actually goes halfway and stops and comes back. We have to open up another hedge at this point. So now we are one lot plus 9.3. We are 1.93 lots long and 1.4 lots short. So again, if it hits our take profit, we are more profitable on these two trades here than we are on this losing trade here. You understand? Any questions? Everybody must be happy and understanding everything, because there's no questions on my board. Nothing from nobody. So everybody knows how to be a trader and hedge, which is great. Makes my job easy because I don't have to explain anymore. So we'll go on to the next slide. I'll see what I've got for you. As I said before, I don't know what slides are. Okay, this was the how to identify trends again. I'll take you back to that screen if I don't have another lot size for you. Let me just erase all of them. Okay. Now, as I said, you will be getting a recording, so don't worry. This is a very important slide. You know, take your conclusions from what I said. This strategy is only a winning strategy if at some point your take profit is hit. Unfortunately, hi John, nice to see you in here. Yeah, I'll send all of you guys out the recording, or actually even better, I will upload it to the YouTube channel. If you go to the webinar section on the website, review previous webinars, it will take you to the homepage of my YouTube, and you can watch the recording on there, no problem. Nice to see you here, John. As I was saying, the conclusions to be taken are: this is not foolproof. This is not, it's real money. It's your hard-earned money. I want to see you be successful, genuinely. CM Trading, we are a outstandingly honest company. We're not a bucket company. We don't take your money and play around with your trades. We look after you. If you use this method correctly, 70 to 90%, you'll get the predictions right. As I said, most people that open up a trade will not hit their take profit on the first go, and sometimes on the second. But when I've used this strategy, I often use this strategy in a ranging market. It's not very good for a strong trending market, so I'm looking for the areas in the market where we have some sideways movement. So my entry is when I see it starting to go sideways, I will use this hedge protection, but it will work as well with your with a trend. You've just got to make sure you get the volume levels correct. What I will do for you is I'll do a webinar again. I'll repeat the webinar, but I'll do it with different volume levels. The previous volume levels are very high. You need to think about your account size. If you're not a $10,000 account, $20,000, you need to divide the volume by 10. So you need to be using minis, not lots. Also, I will go into future depth into how to use algorithms. I'll show you some good websites where you can actually build automated strategies. Very, very simple. Put the inputs that you're using. If you like to use a stochastic, open up a trade on the 20. If stochastic does this, close it. If it does this, it's as simple as that. Algorithms are very good if you don't have the time to trade. I'll take you to a quick chart just to refresh your memories of Heiken Ashi. I'm sure that you saw what's been happening in the market with the Draghi speech. If we go to a lower time frame, we can see the volatility in the market. And the most fascinating thing is, do you guys know how to use Fibonacci for pullback and entry? Does anybody use Fibonacci in here? As I said, also in conjunction with Fibonacci, just drawing a few lines for you because I want to show how the market obeys previous support resistance just very quickly. Let me just draw on here for you. I put this on here because this area interests me. All of this area interests me. Strong support here. It looked like there was going to be support here, but and we can also see here the price obeying what's going on to the left. Everything obeying this price. Now I'll show you a Fibonacci, also like this area here, again here. You see how on the hourly, and if we switch to a daily, we can see channels, straight away, we're identifying sideways movement. I like to use entry strategies when the market's in these channels, in these channels, in these channels. I like to trade when we see that kind of movement sideways. I like it. I like this movement here. And again, you have a channel there. And I'm using the purple lines in conjunction with the stochastic. So, you know, putting in a buy here, you know, putting in a sell here, even though it's not got to the 80, putting in a buy here, sell. Here on the chart was a very strong buy, but the stochastic was atrocious. It didn't give us anything. But Heiken Ashi, if we also use breakout strategy, I'll draw on another channel here. Heiken Ashi with breakout, you know, we can see the color change on this candle, and the breakout strategy, once the market clears this area, as I talked to you before on the previous presentation, using that moving average, as long as that market, its price is staying above here, I'm happy to stay in the trade. I mean, do I get out here or do I get out here? You know, it's purely my decision. As long as the market stays above that area, then I know that I'm safe. The trade is good, it's going to run. What would give me an indication of a possible reversal would be this kind of area on the stochastic. The strong move down gives me an indication that something's going to happen. So you can see, if I just draw with the cursor, I'll put it where the stochastic crosses. You can see that it's just before the candle turns red. So I would have probably stayed in because this area here is going sideways on the stochastic. I would probably have stayed in because of two things. It's above the moving average and there's no cross down through the stochastic. Two things, always remember, entry, you need three things to confirm your entry. Crossing over of the stochastic, color change of the Heiken Ashi, is it on a channel? You know, your channels are very important. If you look on a daily, you know, straight away you identify the trend. You see that the market's trending upwards. You can see that we have very, very strong support on this trend line. This is all support. The market's been obeying this since the 17th of March 2015, and it will continue to obey this until Mr. Draghi sticks his foot in the mess and changes the interest rates. Then we might see something like this going down to below 110. I think 110 is a key area. Controlling of the trend line. I believe that once the market reaches this trend line again, will be a fantastic entry for a long trade. So what I'm waiting for is the stochastic to move below 20 and do something like this. You know, moving up very strongly through the red line. This is a great entry here because it's well below the trigger line. First white candle entry. If you want to use manual trailing stop, you can do. Exit on the first red candle. You know, looks like the stochastic's going sideways underneath. Is it above the below the moving average still? No, it's not. So red candle is a good exit because markets come back through the moving average, and it's also changed color, and also the stochastic's gone down through the red line even though it's below the 80 area. So three things for entry, three things for exit. Euro dollar is one of the best things to trade if you have a small account because it doesn't cost much to trade it. It's very, very liquid. It's cheap to trade. I know that with working with South African market that some people like to trade on the JSE. I don't like it because it's too volatile, too gappy. You know, you can be $1,000 up on the market close, and then when the market opens there's a 1,000 unit change in price and all your profits gone, and so is your account. So this is the reason why I don't like CFDs. If I'm going to trade anything, I'll trade the stock itself, the underlying asset. So we'll clear all of the drawings off. I'm going to leave it there for tonight. Just before I go, anybody have a quick question for me? As I said, you'll all get the recording. I'll make sure that it gets uploaded onto the website. Okay, Francois, I hope the hedging has gone in a little bit. I will show you a different volume range, something that works a little bit better for a smaller account. But basically, on the PowerPoint, I would use a hedging strategy of, let me just go to a slide for you, just to remind you, because I want you to get it right. Okay. I would use something like one lot, 0.1 if you have a small account, and 0.14. So these lot sizes are divided by 10. Question by John: is there somewhere where we can get the slides? I will mail the slides out to you guys. Send me an email, Martino at CM Trading, if I don't have your emails. I can get the slides out to you, no problem. And I'll upload the recording tomorrow for you. And have a wonderful evening. I hope it's helped you guys understand a little bit about protection of trades. It's not about just opening and closing trades. As a professional trader, you have to learn how to manage the trades you got open. If you have a big negative, you can still make money, even if you have a $10,000 account and you're $8,000 negative. You can still make money. You just have to maintain the margin requirement, taking into consideration your swap fees. So you know, we can make money out of this. We're going to make money together, and I'll do something else with you guys in a couple of weeks. Mr. Razak is going to do some money management, I think, next week for you. Have a great evening, everybody, and I'll get anybody who wants slides. You just send me an email. And exactly, yeah, John, you're just saying the problem with the margin. It's very, very easy to blow the account. You think you're safe, you think you're fully hedged, but you don't take into consideration either widening of spread during volatility or margin requirements. So if you want to have a session on something, you know, mail me, Martino at CM Trading. I'll show you the first slide. The email is on there. It's Martino at cmtrading.com. If anybody who wants slides, anybody who wants me to present a webinar on any indicator on the MT4, on any algorithm, you just send me an email. Have a great evening, everybody, and I'll be